What is Forex? Forex is also known as the currencies markets, the FX markets, and the Forex markets. They are the largest financial market in the world, averaging 3.2 trillion in daily trading volume versus 55 billion on the NYSE. All of the world's futures and equities markets combined would only make up a quarter of the dollar volume of the Forex markets. And due to so much competition among the participants, FX markets tend to move in slower trends with lower transaction costs, depending on your broker. And the transaction costs don't come by way of a commission, but by way of spreads. Now, some brokers do offer straight commissions, okay? And then when you think of Forex, just think of it like the ocean and how slow those waves move, or the currents. And transactions are made by buying one currency and selling another currency simultaneously. And that's what's known as pairs. Now, unlike the futures, unlike stock markets, currency trading doesn't take place on a physical exchange, nor is it controlled by a central governing body, no clearinghouses, no arbitration panels. Market forces at its purest make this the most liquid and efficient and accessible market in the world. Now, reputable retail Forex dealers in the U.S., most of them become members of the National Futures Association, the NFA. There's no uptick rule, just like futures, and there's no insider trading rules, interestingly, and there's rarely any gaps. Forex market is a principles-only type of market where the firms are the dealers. There's no brokers like equities, and the dealers assume the market risk by serving as a counterparty to the traders' trades. And basically, when you hear the bad rap about Forex saying that, hey, my broker is trading against me, it's not so much they're trading against you, they are actually the counterparty that is taking your order because they take on all the risk. Dealers make their profits off the bid-ask spread instead of commissions in most cases. Now, some dealers actually will offer you a straight commission, okay, but for the most part, you're paying the bid-ask spread. Currency, Forex, and FX, they're all different names that for the same thing. So the components of a currency pair. When people talk about, the euro is up, or the euro is down, okay, or the pound is strong today, the Aussie dollar is weak today, okay, they're talking about the actual currency pair. A currency pair shows what currency that you're long over the currency that you're short. So the left side is going to be the base currency. When you look at the name, like in the example here, when you look at the name euro or EUR over USD, okay? So whichever is on the left-hand side, that's the currency that you're talking about. So you're talking about the euro dollar. And the left is the base currency, and the right is what we call the quote currency. So a currency pair like the euro dollar, or the euro, okay, represents the number of dollars that 1 euro can buy. So a quote of 1.2800 means that 1 euro equals 1.2800 US dollars. So if you're bullish the euro, you would be long the euro, and in essence, be shorting the dollar. Okay, and if you are bearish on the euro, vice versa. You'd be short the euro, okay, which would be shorting the dollar. Just like you would buy a stock long if you're bullish, or you would buy an FX pair if you're bullish on a specific base currency. And then when we look at the quotes, once again, okay, the symbol is going to be what you're actually trading, so the euro, dollar. And then when we look at the quotes, you'll see something like this. Where you have a quote sometimes with a whole number, like the euro is 1.3640. All right, you have 4 decimal spaces over, and so that is going to be the bid, and the ask is going to be 1.3642. Some brokers will just come right out, flat out, and tell you, if you want to sell, this is what you sell for. If you want to buy, this is what you buy for. Okay, because unlike stocks, you can't split the spread. even if you put in a bid, say at 1.3640, okay, you won't get filled until the actual market or whatever your Forex broker is quoting, the ask moves exactly and matches up with your bid price or what you think is a bid price. So you're always going to be buying on the ask and selling on the bid. Now, you see these smaller numbers next to them, the fifth digit over on the decimal, fifth place over from the decimal, those are what we call baby pips. And the baby pips, you don't have much control over. That's based on your broker and how much leeway that they want to give you. But the brokers, that's just a little extra added commission for the brokers. The baby pips go up to 10, obviously. And so you can have, say, let's say that you're looking to sell at 1.3642, okay? I'm sorry, to buy at 1.3642, 1 baby pip, okay? If you're looking to buy that, you won't get filled. Okay, you have to be matched up with whatever your Forex dealer is showing as their version of the inside bid and ask, including the baby pips. So that's why it's really important, and one of the biggest changes that you will make if you're coming from something like trading equities or futures to trading the FX is you're going to have to factor in the spread. And a tight spread is basically considered 1 to 2 pips. Okay, some of the more widely traded currencies can get up to 3 pips. All right, and then some of the more exotic currencies, wow, those things can go 7 up to 20 pips, a 20 pip spread. Okay, so that's why the spread is real important when you're looking at a chart. You know, when you're looking at projecting a particular target, you know, let's say at a 200 period moving average, and you're long whatever specific currency you're playing. All right, you have to factor in that in order for you to get filled. Okay, if you want to get filled at that bumper level, you're going to have to include that bumper plus the 2 pip spread. Okay, and it may not seem like much, but in a tighter market, and especially in a slow moving market, those 2 pips can seem like mountains. Okay, so to further understand how these currency pairs are function, okay, I know for a lot of you guys it may be a little tough to kind of think in your mind, you know, if I'm playing the euro, why don't they just have a symbol called the euro? Okay, if I'm playing the Aussie dollar, why not just have the Aussie? Or the Kiwi, that's what they call it. But why not just use a symbol like a stock, AUD? Right? Well, it doesn't really work that way. But the way they do it on the FX, in the FX market makes sense. If you think of an analogy like, say you're buying a television at Best Buy. Okay, you're buying a UHD 4K television for $1,000. If you go to Best Buy and you buy the TV, okay, and you buy it for $1,000, in essence, you would be long a TV and short the $1,000. You see that? Now, Best Buy, being a counterparty, okay, would be long your $1,000 and short a TV. So everything works right. Everything fits, and that's just the way the FX markets work. Okay, you have to have a base currency and a quote currency. And they're also exchangeable. Okay, so if you have the euro over the yen, all right, that's when it would come into play. Most of the times when people talk about the euro, they're talking about the euro dollar, so the euro over the U.S. dollar. But there are other currencies that can be substituted for the dollar. So that's why the pairs, when you put them in that sense, almost like a fraction, okay, that's where it really makes sense. Now, going back to the type of pairs, okay, there are 7 pairs that are the most widely traded pairs, and we call them the majors. Of the 7 pairs, there's 4 currency pairs and 3 commodity pairs, which I'll get into in just a minute. But once again, 7 currency pairs make up the majors, which makes up 95% of all the speculative trading that's going on out there.